Welcome to SS2 Economics, Term 2, Week 6. Today we study exchange rates, the price of one country's currency in terms of another country's currency. The exchange rate has profound effects on trade, inflation, investment, and living standards. Nigeria's naira has experienced significant depreciation against the US dollar, from approximately 200 naira per dollar in 2016 to over 1,500 naira per dollar in 2024. Understanding exchange rates, what determines them, how different systems work, and what naira depreciation means for Nigerians, is essential for economic literacy and for WAEC economics. The exchange rate is the rate at which one currency can be exchanged for another. It can be expressed in two ways. The direct quotation expresses the exchange rate as the number of units of domestic currency per unit of foreign currency. For Nigeria, $1 equals 1,500 naira. The indirect quotation expresses it as units of foreign currency per unit of domestic currency. 1 naira equals $0.00067. The nominal exchange rate is the rate actually observed in the market. The real exchange rate adjusts the nominal rate for the difference in price levels between countries. Real exchange rate equals nominal exchange rate times domestic price level divided by foreign price level. If Nigeria's inflation is higher than US inflation, the naira depreciates in real terms. Even if the nominal exchange rate stays the same, Nigerian goods become more expensive relative to US goods. The effective exchange rate is the average of exchange rates against all trading partner currencies, weighted by the share of trade with each partner. The CBN monitors the effective exchange rate of the naira. There are three main types of exchange rate systems. Under a fixed exchange rate system, the central bank commits to maintaining the exchange rate at a specific value against a reference currency or commodity, such as the US dollar or gold. To maintain the rate, the central bank buys and sells foreign exchange as needed. The Bretton Woods system, 1945 to 1971, was a fixed exchange rate system. Advantages: exchange rate certainty reduces business risk, low exchange rate volatility. Disadvantages: requires large foreign reserves, eliminates exchange rate as a policy tool, may lead to overvaluation and loss of reserves. Under a floating, flexible exchange rate system, the exchange rate is determined entirely by the forces of supply and demand in the foreign exchange market. No central bank intervention. The US dollar, euro, British pound, and Japanese yen all float. Advantages: automatic balance of payments adjustment, CBN free to focus on domestic objectives. Disadvantages: exchange rate volatility creates business uncertainty, currency speculation can destabilize rates. Under a managed float, dirty float system, the exchange rate is primarily market determined, but the central bank intervenes occasionally to smooth excessive volatility or move the rate towards a desired level. Most countries today, including Nigeria after the 2023 unification, use a form of managed float. Before 2023, Nigeria maintained multiple exchange rates: official, investors and exporters, INE, window, BDC rate, which created distortions, rent-seeking, and a large parallel, black, market. In a floating exchange rate system, the naira-dollar rate is determined by the supply of and demand for naira in the foreign exchange market. Supply of naira, demand for dollars: Nigerians who want to import goods or services, Nigerian firms wanting to invest abroad, or individuals sending remittances abroad all demand dollars, and they supply naira to obtain those dollars. The supply of naira rises when imports rise, domestic interest rates fall, discouraging foreign investors, or inflation in Nigeria is high relative to the US. Demand for naira, supply of dollars: foreign buyers of Nigerian exports, oil companies paying for Nigerian crude in dollars, then converting to naira, foreign investors buying Nigerian assets, and Nigerians in the diaspora sending remittances all demand naira, and they supply dollars to obtain it. The demand for naira rises when oil export earnings rise, foreign investment inflows rise, or Nigerian interest rates rise relative to US rates. The equilibrium exchange rate occurs where supply of naira equals demand for naira. If supply of naira exceeds demand, the naira depreciates. If demand for naira exceeds supply, the naira appreciates. Nigeria's naira depreciated sharply in 2023 because oil production was below target, dollar supply from exports fell, while dollar demand for imports remained high and foreign exchange reserves were limited. Naira depreciation, naira buying fewer dollars, has complex effects on Nigeria. On imports, imports become more expensive in naira terms. Petrol, manufactured goods, machinery, medicines, and food imports all rise in price. This is a major source of inflation in Nigeria, given the high import dependence of the economy. On exports, Nigerian exports become cheaper in dollar terms, though oil is priced in dollars, so this effect is limited for oil. It benefits other exports like cashew, sesame, and processed goods. On foreign debt, Nigeria's external debt, owed in dollars, becomes larger in naira terms when the naira depreciates, increasing the naira cost of debt service. On remittances, diaspora remittances are worth more in naira terms when the naira is weaker, good for recipient households. On investment, depreciation makes Nigerian assets, shares, land, businesses, cheaper for foreign investors in dollar terms, potentially attracting more FDI. On domestic industry, if import substitution industries can ramp up production, depreciation makes their products more competitive against imports, but in Nigeria, many industries depend on imported inputs, so depreciation raises their production cost. Naira appreciation, naira buying more dollars, has the opposite effects: cheaper imports, lower inflation, reduced export competitiveness, and cheaper dollar debt service. To summarize, the exchange rate is the price of one currency in terms of another. Direct quote, naira per dollar. Indirect quote, dollars per naira. The real exchange rate adjusts for price level differences. Exchange rate systems, fixed, central bank maintains rate, floating, market determined, managed float, primarily market with occasional intervention, Nigeria's current system. The naira exchange rate is determined by the supply of naira, demand for dollars, and demand for naira, supply of dollars. Naira depreciates when oil earnings fall, imports surge, or inflation exceeds trading partners. Effects of depreciation: higher import prices, inflation, more expensive foreign debt in naira, cheaper exports, and more valuable remittances in naira terms. Nigeria moved from multiple exchange rates to a managed float in 2023, causing initial sharp depreciation but greater transparency. For WAEC, define exchange rate, distinguish direct and indirect quotation, explain fixed versus floating systems, explain how exchange rates are determined by supply and demand, and explain the effects of depreciation and appreciation on Nigeria.